All right, so let's get started on our chapter regarding corporate formation, corporate form of business organization, stockholders, types of stock, and dividends, both cash dividends, stock uh, splits, and treasury stock. So, a lot of stuff to talk about, but we're going to get started with this first little handout video. There's not a whole lot to it. This will be a shorter video just to kind of understand some of the basics on the topic. So when we look up here at the first question, we have a question about the corporate form of organization, and it says which one of the following would not be considered an advantage of the corporate form of organization. And we've got A, B, C, and D, as always. So want to acknowledge that all four of these items are characteristics of a corporate uh, form of business organization. So when we look at these, we want to say, okay, is there any potential advantage to these? So anytime we see government regulation, it's going to be tough to find an advantage to that, at least from the perspective of the corporation itself. The stockholders get some advantage from that, protections, but not so much the corporation. But let's make sure that we're on the right path and look at these other ones. Separate legal existence. This is what allows a corporation to enter into contracts as its own entity. All right, and what that does, that is an advantage that is actually directly related to D here, limited liability of stockholders. So when a stockholder invests into a corporation, if anything happens, if the corporation is sued, individual stockholders have limited liability, limited to the amount of their investment in the company's stock. And that's possible because of choice B. So both of these are advantages. And then continuous life. Unlike a sole proprietorship where we may have an individual retire or pass away and the business just kind of ends, corporations have continuous life. So it looks like our correct answer is going to be A. Government regulation would not be an advantage. All right, second question says, one of the main disadvantages of the corporate form is the, all right, inability to raise large capital amounts of to raise large amounts of capital. Well, this is kind of the opposite. Corporations are allowed to raise large amounts of capital, really in a couple of ways, but to keep the focus on the content for this chapter, they can simply issue stock. All right, so that's not correct. Double taxation of dividends. This is going to end up being our answer because if a corporation has net income, they're going to pay tax on that. Then they're going to distribute some of that, generally speaking. If they do distribute dividends, the receiver of those dividends is going to pay tax on them as well. The individual investor is going to pay tax on the dividends received, and then the corporation is going to pay tax on the dividends that they paid out. So that's not a good thing. True false question says the main source of paid in capital is from issuing stock. We know that from our discussion in accounting one or financial accounting one, whatever the case may be, that that we've got basically two parts of stockholders' equity. One of those is retained earnings, which doesn't have anything to do with stock. But what this question is asking is as the main source of paid in capital. So paid in capital is simply owner investment, and that's the very definition of stock. So this is a true statement. All right, let's see if we can't straighten that up a bit. All right, so let's see what the next question has for us here. It says the state charter allows a corporation to issue only a certain number of shares of each class of stock. This amount of stock is called, all right, so we got to understand the kind of the order that this happens. The board of directors, based upon the state charter, is going to first authorize, then issue stock, and then we would say that shares currently owned are outstanding shares. So the bottom line is D is going to be our answer. That is the first step in the process. All right, and then the last question for this video is going to be the number of shares sold to stockholders is called, well, we authorize stock, then we sell it to the stockholders here. So it's going to be issued stock. Just to clarify, outstanding stock is stock that is currently owned by stockholders, and we'll get to the PowerPoint video has the, how we get to the difference between issued stock and outstanding stock. But we're going to talk a little bit later about how that difference occurs. But for now, we're only concerned about the number of shares sold, and that is stock issued. If you're in one of my classes and you have this handout, there's one more question, and that question is misplaced. So we're going to pick that up on a later video. So that'll be it for this one.